Hello, everybody. I'll try and make this brief so that we can have more time for questions and keep it a bit more interactive. Just as a brief introduction, as mentioned, my name is Nikhil Gandesha. I'm the Managing Director of Finomni. I'm also a specialist consultant for the Royal United Services Institute, which is a think tank for the Ministry of Defence in the UK. My background is banking and financial services. I've worked for large banks here in Dubai, in the UK and in Hong Kong. And so the purpose of this presentation is to review the financial crime issues in an ever-changing landscape. So I think we've had quite good sessions so far that are talking about how technology and the financial landscape is changing. So I just wanted to take some time to talk about the financial crime risks within that. So if I move to the next slide, hopefully. Yeah. So this graph here just gives an example of how the enforcement from various regulators has increased over the time, and this is a graph from 2019 from the World Economic Forum. What's interesting to see here is the totals that have been enforced. So the graph shows the volume, but if we look at the data, then there's 8.14 billion worth of fines last year. The United States and the United Kingdom are leading those, but what's interesting is other countries are now catching up. So if you compare this to previous years, places like India are now enforcing regulation a lot more, and that trend is looking to continue. The other interesting factor here is that historically, the majority of the fines have been to large institutional banks, but for the first time in 2019, the amount of fines to banks as a proportion was below 50%, which shows that the regulators are looking all around and understanding that financial crime is not just a banking issue, but a wider financial services issue and also an issue for business as a whole. So, So the trends in regulation, and some of it has been talked about today, is as follows. What we're seeing with our clients and with the regulators that we speak to is that transaction monitoring and the reporting of STRs are still a big issue here in the UAE, but also in Asia Pacific and the UK and the US. It comes down to the fact that there are a lot of the financial institutions and fintechs have to deal with a high volume of transactions, and the feedback loop from regulators is not as good as it should be. So the alerts are not producing that good, not great alerts are being produced, and the feedback loop doesn't allow the financial institution to evolve. Technological innovation outside of the financial institutions is increasing at a fast pace, as we've gone through with the sessions today, but the institutions themselves are struggling to keep up with that and embed it, especially with legacy issues and larger transformation projects, and the kind of lack of efficiency in that and the time that it takes. The other key here is what's been trending in the last couple of years is the introduction of proliferation finance risk as a separate pillar within the overall AML assessment. So proliferation finance is the financing of weapons of mass destruction, and with sanction regimes, firms are being pushed further to include that within their risk assessments and identify any potential links, not just directly to their customers, but through their network of customers, to see how responsive they are to that risk. So one of the great innovations over the last sort of 10 years or so has been the EU KYC and the introduction of digital identities, and this is evolving faster in the last few years. But it does still present some financial crime issues, the main one being that identity fraud and the replication of identities means that the accounts, especially within the fintech space, can be created much quicker, and it allows the money to flow through at a higher velocity. So So it does help with money laundering. But overall, it's definitely the step in the right direction that was needed. And apart from the cybersecurity threat, this will be one of the ways that we can actually fight financial crime more effectively. That is, if we ensure adequate oversight over that. So one of the key things that regulators are looking for is a stringent mechanism and policies and procedures on how eKYC and digital identities are looked at. So if your firm is using an external provider, a third party, then how often do you assess them? How robust are they? What sources do they use? Are you assessing the sources? And if it's an in-house system, then again the same, but assessing the in-house capabilities. One of the things that this depends on for it to be successful, and I think it was mentioned a few times, is the ability to create a cohesive ecosystem. So if institutions are able to get together, and this has started happening in places like the UK with GIMLET, the Joint Money Laundering Task Force, if providers of digital solutions, the financial institutions, and most importantly the regulators come together and create this system, then rather than operating in silos, the sharing of data will help the overall fight against financial crime. So I think there's a session on this today which is really interesting, so I won't go into too much, but from a financial crime point of view, AI and blockchain are the future. Again, it's dependent on how well it's implemented and how effectively institutions can take it on. The spending in AI, for example, across larger financial institutions is massive, but the effectiveness is very low. And so that's one of the challenges, and I think it sort of feeds to the last session that we had, that the partnership between providers, technology companies, fintechs, as well as larger financial institutions, traditional financial institutions, needs to be stronger in order for this to work effectively. One point I did want to just highlight is the idea of intelligent segmentation. So traditionally with your customer data, it's a rules-based system where alerts are identified. You assess them, whether the machine assess them or you assess them against the customer's profile. What intelligent segmentation allows is, rather than having the rules that are created from typologies that are a little bit more generic, intelligent segmentation takes the customer's data itself, puts it, uses it, the machine learns how that customer behaves as an individual entity rather than as a holistic view, and therefore compares that against the alerts that are happening. The result in this is you get much more efficient alerts, a lot less false positives. So it's something that's been in the market for a little while, but hasn't been implemented everywhere yet. But it's something that is definitely on our radar, and a lot of clients that we've worked with are trying to implement this effectively. Blockchain, again, it's a very has the potential to transform the financial crime market. A lot of fintechs in the UK are using blockchain as their financial crime combating tool. It can obviously be used for trade documents, the usual CDD KYC process, as well as credit risk. But from a financial crime point of view, if you're able to see the whole journey for the customer, whether it's transaction-based or document-based, you open up a lot of doors, and it makes it a lot easier to fight criminal networks. Again, the theme for most of these points will be it's dependent on a cohesive regulatory base, as well as stakeholders working together across the industry. So all of this changing regulation, the new technology, etc., brings its sense of compliance challenges. I'm sure everybody here is aware of the compliance challenges that are there. More regulation means more effect on the bottom line. Talent is a big issue that we see a lot of our clients talk about, and finding the right talent with the right skill set. It comes to the points and the themes that have been there today about upskilling rather than looking out and focusing on the internal talent that you have. And when you are recruiting outside, having a look at the fit of the individual rather than specific skill sets. If you've got the upskilling and the training environment set up in your company, then you can hire a more diverse group of people and have different thinking. The cultural shift is an important one. A lot of regulators are now looking at personal liability within the senior management, C-suite, and the compliance staff. So that will change. Rather than being able to hide behind the rule book, I think we're all going to be able to be at a point where we're liable for the decisions that we make. And the geopolitical environment, so Brexit, the US elections, Hong Kong protests, the list is endless over the last year. That does change the way that regulators look at it. If you're trying to build a cohesive, effective system, not just domestically, but regionally and internationally, if you've got countries, political systems that are operating in silos, it's going to be a lot more tougher. So with all of these challenges in terms of the financial crime space, what can firms do? I'm sure most people are aware, but the two key themes that are consistent, have been consistent for the last 20 years, maybe even before that, is having an effective governance structure and conducting regular risk assessments. An effective governance structure means that when there is an issue, and this applies to every element, but specifically here we're talking about financial crime, the senior management are, the issue is escalated, it can be mitigated in a time-effective way, but most importantly, it ensures that the firm is acting within its risk appetite. When you have external monitors that I've worked with before, or regular auditors coming in, one of the things that they will look for is how was this decision made, and if you can, even if the decision consequently turned out to be a bad one, if there is an effective governance structure there, you're much more likely to be able to justify and explain why the decision was made. A risk assessment is a great way to be able to keep up with what's going on, but also ensure that you're managing your risk appetite and your book very well. So both from a risk perspective, but also from a commercial perspective. If you're in a market that is very high risk, but you're not making a lot of money from it, this is an area again where you can review that and have a look at how we can do that. So I'll come on to the risk assessment in more detail a bit later. These are just some examples of where we've seen clients who have good governance and poor governance. There's 3 slides here. I'll go through them relatively quickly. But the key theme on this one is that where we've seen poor governance in the AML structure, it's generally been where the senior management is either not part of the decision making or is just aloof to it. Westpac is a brilliant example of this. They had alerts over the last 15 years that were calling out for something to be done, and nothing was done, and now they are in the situation that they are in. Again, the systems and controls, the controls are purely on a reactive basis. They're contacted by law enforcement or a trigger that's outside of the company. There's nothing proactive being done in the company. That's generally the examples of poor practice that we see. Again, good practice is where the senior management are aware of the technology and controls that are in place, how the systems work, and it's all the way up to board level. And the same with sanctions. Again, the firms working with other firms to look at sanctions governance, not being aware of the surrounding challenging markets that sort of help negate sanctions, etc. So I think I've covered most of this, but this is just a summary as well of why you would want to conduct a risk assessment. The key here, as well as the senior management issue that we missed, is that it can help to identify any control gaps that you have. So if there are issues within the firm, a risk assessment on a periodic basis means that can be resolved. The other element is, from a strategic point of view, if new technology is coming out, if you're using third-party technology providers, you're able to review them on a regular basis as part of this process to ensure that you're keeping up with what is happening in terms of regulation and technology, and make amendments if necessary. And the overall reason, the way to conduct the risk assessment is to look at the inherent risks, so the clients, the products and services, the countries that the work is being done in, which the controls that are in place to do that, whether that's KYC, transaction monitoring, the governance structure, how a SAR is filed, and then that will identify the gaps that you will then action, whether it's a strategic medium to long-term view or a tactical change that needs to be done immediately.